I think the market is being moved by the news on the specifics of the lockdowns and their relaxation. As far as how meaningful it all is, I have serious doubts, because our view is that the thing that's going to cause the stock market to relapse again is the state of the economy, which is dramatically down, and therefore earnings with it in the stock market, and that, of course, influences investor behavior. And we also think that the recovery, as and when it comes from this, will be fairly modest, even on the good assumptions about solutions to the actual problems of lockdown and the disease. Specifically, we don't see that people are going to be readily going back to sports events and theatres and restaurants and bars and in close proximity with one another, so long as there isn't a vaccine that pretty much promises that they will be safe in doing so. So the recovery of demand, which has been the cause of this downswing, is likely to be quite modest and quite slow. There'll be a little bounce and then probably a significant slowdown.
Charles, good morning to you. I've been reading the TS Lombard research over the last week or so avidly. Look, I get your degree of pessimism and realism about what we're seeing in the markets versus the economy. But one added ingredient I wanted to get your view on was market distortion. Market distortion from central banks and from governments as well, either via support mechanisms or outright buying of underlying product and ETF as well. How much can the support mechanisms distort real valuations that would reflect the underlying economy?
Well, I think the problem is that people are expecting the same sort of results from central bank intervention as we've had for most of the last 10 years, which has been extremely helpful for asset prices, not so helpful for the economy, because, arguably over the last 10 years we could have done with much more Keynesian-type actual government spending and less attempted stimulus through through monetary means, whether it's quantitative easing or straightforward low to negative interest rates. So, there has been, people have been accustomed to the idea that when central banks make a move, then everything will go up. And in particular, the fiscal policy is standing in there to support firms in what are fairly dire circumstances. The problem we have is that we don't see the recovery being all that brisk, and the earnings are likely to be relatively weak all the way through this year and into next year. And as a result of all of that, we don't think that the stock market is going to be able to sustain the very high levels of prices that have been achieved over the last week or two, and look as if they're going to be achieved again today or this week, maybe. But in other words, basically, we think that earnings are going to be disastrously low, and the stock market multiples will come down to reflect the rather less buoyant prospects than people are supposing, just because of the intervention of central banks. It's got to be remembered, you see, that the fiscal policy response so far has been very constructive in the sense of supporting firms through difficulties, but it hasn't got all that much going for it in terms of actual generating spending, on top of the fact that spending by private individuals, consumer spending, is weak. And business capex is likely to follow that with weakness too. So there isn't actually anything which is going to cause rapid recovery of demand in the economy. And so central banks and governments being supportive of businesses in difficulties is very nice, but it won't actually cause the recovery which the market appears to be anticipating.